Breakout strategies, establishing a support line followed by a resistance line and patiently awaiting that decisive moment. The moment when the price abruptly breaks through, and when it breaks through, it shatters all barriers. But how does one successfully trade this strategy? Is there even a strategy? Are there any secrets? Well, indeed, there are a few, and fortunately for you, I'm here to share them in this video. Let's not waste any time. Let's dive right in. Have you ever experienced this? You set your support line, you set your resistance line, and patiently await a breakout. Once you witness the price suddenly breach your resistance, you enter a trade with great excitement, anticipating a substantial price surge. You grab your popcorn, settle in, fix your gaze on your monitor, but then suddenly, the price reverses and plummets. You find yourself perplexed, wondering what just happened as your portfolio takes a nosedive. Well, I'm going to reveal a secret that will prevent this from happening to you again. So the first question we must ask ourselves is, what exactly is a breakout? A breakout occurs when we have both a support and a resistance level with multiple significant rejections at each. The actual breakout occurs when the price forcefully penetrates one of these key levels. And notice what happens next. The price starts to soar, making this particular point an excellent entry point. But here's the real question. How do we identify setups like these, where the market potentially exhibits a breakout? The answer lies in breakout patterns. I'm sure you're all familiar with these, but it's crucial to keep several essential breakout patterns in mind when trading. There are various breakout patterns to consider, such as the wedge, flag, rectangle, triangle, and pennant. However, one common mistake I observe is that many people fixate on finding the exact price action depicted in the pattern image. In reality, the price rarely mirrors the precise pattern illustrated in the image, if ever. Instead, focus on identifying the key support and resistance levels that define the pattern. To be honest, it's not crucial to remember the names of the patterns or to prioritize one over the other. What matters most is recognizing the shared characteristic among all these patterns: price consolidation, which leads to the formation of two significant levels, followed by a breakout. Let's consider an example where we observe price movement that appears to have multiple key support and resistance points. The more distinct these points are, the better. In this scenario, we acknowledge the occurrence and draw support and resistance lines, creating a rectangle pattern. So far, so good. However, this is where many people often make a mistake. They wait for a breakout in either direction. Once they witness the price breaking through their resistance line, they immediately enter the trade. Unfortunately, it turns out to be a false breakout and the price reverses in the opposite direction. This particular trader would have incurred a significant loss. I'm going to demonstrate how to avoid such situations and increase our chances of the price moving in the desired direction. The first concept we need to understand is what we call momentum candles. Momentum candles can take various forms, but typically they consist of one large candle with a substantial body or three medium-sized candles, all moving in the same direction. These two variations of momentum candles are the ones we should be on the lookout for. Allow me to provide you with an example. In this particular case, we have a series of multiple higher highs, enabling us to establish a resistance level at this point. Additionally, we identify a crucial support level where the price has reversed multiple times. Now we wait. We observe the formation of a fairly substantial candle that manages to break through the resistance level. However, we cannot consider it a momentum candle because only the tip of it crossed the line. To qualify as a momentum candle, the majority of the candle's body would need to breach the resistance level. Another scenario where we would recognize it as a momentum candle is if another green candle appears outside the line, like this. Unfortunately, in this case, a red candle emerges instead, leading us to disregard this signal. And as you can see, it turns out to be a false breakout. Allow me to present another example. Here we have our support and resistance levels established and the price begins to move. A moderately sized candle breaks through our resistance level. However, it fails to qualify as a momentum candle due to its relatively small body. Therefore, we await further confirmation. Another candle materializes, but it remains relatively diminutive. As we mentioned earlier, we only consider it a momentum candle if it possesses a sizable body or if there are three consecutive green candles. So we exercise patience once again. Finally, a third green candle emerges, indicating an extremely bullish signal. This is when we enter the trade. Now, there are three potential scenarios that could unfold. The price may continue to rise from this point onward. Alternatively, it might retrace back to the resistance level and rebound. Lastly, there is the possibility of the price breaking through the resistance level, only to subsequently fall back down, classifying it as a false breakout. So what should we do? Should we wait for a pullback to occur, or should we enter the trade right away? Well, what I prefer to do is establish a strategy that puts the odds in my favor, regardless of the outcome. Instead of waiting for a pullback, I choose to enter the trade at the close of the momentum candle. Then, I set my stop loss just below the resistance level. This way, if the price does pull back and bounce off the resistance level, it won't hit my stop loss and I can still make a profit. On the other hand, if the price decides to continue upward from that point, I'm already in the trade. Now, considering this candle here is a momentum candle, the chances of it being a false breakout are quite low. Nonetheless, I have a stop loss in place in case the price unexpectedly drops. Now that we have our entry point, we need to determine an exit strategy. Breakouts often have significant upside potential. If we were to settle for a standard 1.5 profit ratio, we would be missing out on a substantial amount of profit. To ensure that we take advantage of the significant profits, I employ what I call the two-step take profit system. Here's how it works. First, we identify our entry signal and place the stop loss below the resistance line. Then, we set our take profit level at a 1.5 ratio. Once the price reaches our take profit mark, we sell half of our shares to secure that profit. The remaining half remains in the trade. Next, we raise our stop loss to the previous take profit level. Our next take profit mark is determined by an indicator known as the chandelier indicator. To add this indicator, simply go to TradingView, navigate to the Indicators tab, and search for Chandelier Stop. Then, adjust the indicator settings by changing the ATR multiplier to 2. This indicator will serve as our exit strategy. It's straightforward. We sell the remaining half of our shares when the chandelier indicator changes colors. As you can see, by selling only half of our shares, we generate additional profits. If we had sold all of our shares at the 1.5 profit mark, we would have missed out on significant upside potential. Additionally, you can observe that the price went straight up without forming a pullback. This is why I prefer to enter the trade right away, as most breakouts tend to move upward without retracements. Let's examine one more example. We identify key levels that serve as excellent support and resistance levels. Once we establish our trend lines, we wait for a momentum candle to break through our resistance. While one candle breaks through, it lacks a substantial body, so we wait for 2 more consecutive green candles. Once we see the 3 candles, we enter the trade. We then place our stop loss below the resistance line and set our take profit at a 1.5 ratio. We wait for the price to reach our take profit level and sell half of our shares. After selling half, we move our stop loss to the previous take profit mark and activate the chandelier indicator. We wait for the indicator to change colors before selling the remaining shares and exiting the trade. I've shared some secrets to enhance your breakout trading strategy. All I ask in return is for you to take a moment and like this video. If you want to see part 2 of this video and make this strategy even more profitable, check out the link provided. Thank you for watching, and I'll see you next time.